Chapter 16, Central Banks and the Federal Reserve System. Preview. Among the most important players in financial markets throughout the world are central banks, the government authorities in charge of monetary policy. Central banks' actions affect interest rates, the amount of credit available, and the money supply, all of which have direct impacts not only on financial markets, but also on aggregate supply, output, and inflation. To understand the role that central banks play in financial markets and the overall economy, we need to understand how these organizations work, who controls central banks and determines their actions, what motivates their behavior, who holds the reins of power. In this chapter, we look at the institutional structure of major central banks and focus particularly on the Federal Reserve System, one of the most important central banks in the world. We start by examining the elements of the Fed's institutional structure that determine where the true power within the Federal Reserve System lies. By understanding who makes the decisions, we have a better idea of how they are made. We then examine the reasons behind central bank behavior and whether it is a good idea to make central banks independent by insulating them from politicians. Finally, we look at the structure and independence of other major central banks, particularly the European Central Bank. With this context in place, we will be prepared to comprehend the actual conduct of monetary policy described in the following chapters. Origins of the Federal Reserve System. Of all of the central banks in the world, the Federal Reserve System probably has the most unusual structure. To understand how this structure arose, we must go back to before 1913, when the Federal Reserve System was created. Before the 20th century, a major characteristic of American politics was the fear of centralized power. As seen in the checks and balances provisions of the Constitution and the preservation of states' rights, this fear of centralized power was one source of American resistance to the establishment of a central bank. Another source was a traditional American distrust of moneyed interest, the most prominent symbol of which was a central bank. The open hostility of the American public to the existence of a central bank resulted in the demise of the first two experiments in central banking, whose function it was to police the banking system. The first Bank of the United States was disbanded in 1811, and the national charter of the Second Bank of the United States expired in 1836 after its renewal was vetoed in 1832 by President Andrew Jackson. The termination of the bank's national charter in 1836 created a severe problem for American financial markets because there was no lender of last resort that could provide reserves to the banking system in order to avert a bank panic. Hence, in the 19th and early 20th centuries, nationwide bank panics became a regular event occurring every 20 years or so, culminating the Panic of 1907. The 1907 panic resulted in such widespread bank failures and such substantial losses to depositors that the public was finally convinced that a central bank was needed to prevent future panics. The hostility of the American public to banks and centralized authority meant great opposition to the establishment of a central bank like the Bank of England. Fear was rampant that the moneyed interests on Wall Street, including the largest corporations and banks, would be able to manipulate such an institution to gain control over the economy, and that the federal operation of the central bank might result in too much government intervention in the affairs of private banks. Serious disagreements existed over whether the central bank should be a private bank or a government institution. Because of the heated debates on these issues, a compromise was struck. In the great American tradition, Congress wrote an elaborate system of checks and balances into the Federal Reserve Act of 1913, which created the Federal Reserve System with its 12 regional Federal Reserve banks. Structure of the Federal Reserve System. The writers of the Federal Reserve Act wanted to diffuse power along regional lines between the private sector and the government, and among bankers, business people, and the public. This initial diffusion of power resulted in the evolution of the Federal Reserve System to include the following entities: the Federal Reserve Banks, the Board of Governors of the Federal Reserve System, the Federal Open Market Committee, or FOMC, the Advisory Council, and around 2,000 member commercial banks. Figure 1 outlines the relationships of these entities to one another and the 4 policy tools of the Fed: open market operations, the discount rate, reserve requirements, and interest paid on reserves, discussed in chapters 17 and 18. Federal Reserve Banks. Each of the 12 Federal Reserve districts defined by the Federal Reserve Act of 1913 has one main Federal Reserve Bank, which may have branches in other cities in the district. The locations of these districts, the Federal Reserve Banks, and the Federal Reserve Bank branches are shown in Figure 2. The 3 largest Federal Reserve Banks in terms of assets are those of New York, Chicago, and San Francisco. Combined, they hold more than 50% of the assets, discount loans, securities, and other holdings of the Federal Reserve System. The New York Bank, with around 1/4 of the assets, is the most important of the Federal Reserve Banks. Each of the Federal Reserve Banks is a quasi-public, part private, part government institution owned by the private commercial banks in its district that are members of the Federal Reserve System. These member banks have purchased stock in their district Federal Reserve Bank, a requirement of membership, and the dividends paid by that stock are limited by law to 6% annually. The member banks elect 6 directors for each district bank. 3 more are appointed by the Board of Governors. The directors of a district bank are classified into 3 categories: A, B, and C. The 3 A directors elected by the member banks are professional bankers, and the 3 B directors are also elected by member banks, are prominent leaders from industry, labor, agriculture, or the consumer sector. The 3 C directors who are appointed by the Board of Governors to represent the public interests are not allowed to be officers, employees, or stockholders of banks. The directors oversee the activities of the district bank, but their most important job is to appoint the president of the bank, subject to the approval of the Board of Governors. Up until 2010, all 9 directors participated in this decision, but the Dodd-Frank legislation passed in July 2010 excluded the 3 Class A directors from involvement in choosing the president of the bank. Congress viewed it as inappropriate for bankers to be involved in choosing the president of the Federal Reserve Bank that would have supervisory oversight of these same banks. The 12 Federal Reserve Banks are involved in monetary policy in several ways. Their directors legally establish the discount rate, although the discount rate is in practice set at a fixed amount over the federal funds rate target. They decide which banks member and non-member alike can obtain discount loans from the Federal Reserve Bank. Their directors select one commercial banker from each bank's district to serve on the Federal Advisory Council, which consults with the Board of Governors and provides information that helps in the conduct of monetary policy. 5 of the 12 bank presidents each have a vote on the Federal Open Market Committee, which directs open market operations, the purchase and sale of government securities that affect both interest rates and the amount of reserves in the banking system. As explained in the Inside the Fed box, the special role of the Federal Reserve Bank of New York, because the president of the New York Fed is a permanent member of the FOMC, he or she always has a vote on the FOMC, making the New York Fed the most important of all banks. The other 4 votes allocated to the district banks rotate annually among the remaining 11 presidents. The 12 Federal Reserve banks also perform the following functions: clear checks, issue new currency and withdraw damaged currency from circulation, administer and make discount loans to banks in their districts, evaluate proposed mergers and applications for banks to expand their activities, act as liaisons between the business community and the Federal Reserve System, examine bank holding companies and state-chartered member banks, collect data on local business conditions, use their staff of professional economists to research topics related to the conduct of monetary policy. Member banks. All national banks, commercial banks chartered by the Office of the Comptroller of the Currency, are required to be members of the Federal Reserve System. Commercial banks chartered by the states are not required to be members, but they can choose to join. Currently, about a third of the commercial banks in the United States are members of the Federal Reserve System, having declined from a peak figure of 49% in 1947. Before 1980, only member banks were required to keep reserves as deposits at the Federal Reserve banks. Non-member banks were subject to reserve requirements determined by their states, which typically allowed them to hold much of their reserves in interest-bearing securities. Because at the time no interest was paid on reserves deposited at the Federal Reserve banks, it was costly to be a member of the system, and as interest rates rose, the relative cost of membership rose. More and more banks left the system. This decline in Fed membership was a major concern of the Board of Governors. One reason was that it lessened the Fed's control over the monetary supply, making it more difficult for the Fed to conduct monetary policy. The chair of the Board of Governors repeatedly called for new legislation requiring all federal banks to be members of the Federal Reserve System. One result of the Fed's pressure on Congress was a provision in the Depository Institutions Deregulation and Monetary Control Act of 1980. All depository institutions became subject by 1987 to the same requirements to keep deposits at the Fed, so member and non-member banks would be on equal footing in terms of reserve requirements. In addition, all depository institutions were given equal access to the Federal Reserve facilities, such as the discount window discussed in Chapter 18, and the Fed check clearing. These provisions ended the decline in Fed membership and reduced the distinction between member and non-member banks. Board of Governors of the Federal Reserve System. At the head of the Federal Reserve System is the 7-member Board of Governors, headquartered in Washington, D.C. Each governor is appointed by the President of the United States and confirmed by Senate. To limit the president's control over the Fed and insulate the Fed from other political pressures, the governors can each serve one full, non-renewable 14-year term plus part of another term, with one governor's term expiring every other January. The governors, many are professional economists, are required to come from different Federal Reserve districts so that the interests of one particular region of the country are not overrepresented. The chair of the Board of Governors is chosen from among the 7 governors and serves a 4-year renewable term. It is expected that once a new chair is chosen, the old chair will resign from the Board of Governors, even if many years are left in his or her term as a governor. The Board of Governors is actively involved in the conduct of monetary policy in the following ways. All 7 governors are members of FOMC and vote on the conduct of open market operations. Because only 12 voting members are on this committee, 7 governors and 5 presidents of the district banks, the board has a majority of the votes. It sets reserve requirements within limits imposed by legislation. It sets the interest rate paid on reserves. It effectively controls the fixed amount by which the discount rate exceeds the federal funds rate target by means of the review and determination process, whereby it approves or disapproves the discount rate established by the Federal Reserve banks. The chair of the board advises the President of the United States on economic policy, testifies in Congress, and speaks on behalf of the Federal Reserve System to the media. Through legislation, the Board of Governors has often been given duties not directly related to the conduct of monetary policy, which are as follows: sets margin requirements, the fraction of the purchase price of securities that must be paid for with cash rather than borrowed funds, sets the salary of the President and all officers of each Federal Reserve Bank, and reviews each bank's budget. Approves bank mergers and applications for new activities, specifies the permissible activities of bank holding companies, and supervises the activities of foreign banks in the United States. Hires a staff of professional economists, larger than the staffs of individual Federal Reserve banks, who provide economic analysis that the Board of Governors then uses in making its decisions. Federal Open Market Committee, FOMC. The FOMC usually meets 8 times a year, about every 6 weeks, and makes decisions regarding the conduct of open market operations, the setting of the policy interest rates and federal funds rate, which is the interest rate on overnight loans from one bank to another, and is the setting of the interest rate paid on reserves. Indeed, the FOMC is often referred to as the Fed in the press. For example, when the media report that the Fed is meeting, they actually mean that the FOMC is meeting. The committee consists of the 7 members of the Board of Governors, the President of the Federal Reserve Bank of New York, and the presidents of 4 other Federal Reserve banks. The chair of the Board of Governors also presides as the chair of the FOMC. Even though only the presidents of 5 of the Federal Reserve banks are voting members of the FOMC, the other 7 presidents of the district banks attend FOMC meetings and participate in discussions. Hence, they have some input into the committee's decisions. Because prior to 2008, open market operations were the most important policy tool the Fed had for controlling the money supply, and because it is where decisions about tightening of monetary policy, a rise in federal funds rate and the interest rate paid on reserves, or easing of monetary policy, a lowering of the federal funds rate and the interest rate paid on reserves are made, the FOMC is necessarily the focal point for policy making in the Federal Reserve System. Although reserve requirements and the discount rate are not actually set by the FOMC, decisions in regard to these policy tools are effectively made there, and this is why Figure 1 includes dashed lines indicating that the FOMC advises on the setting of reserve requirements and the discount rate. The FOMC does not actually carry out securities purchases or sales. Instead, it issues directives to the trading desk at the Federal Reserve Bank of New York, where the manager for domestic open market operations supervises a room full of people who execute the purchases and sales of the government or agency securities. The manager communicates daily with the FOMC members and their staffs concerning the activities of the trading desk. Why the chair of the Board of Governors really runs the show? At first glance, the chair of the Board of Governors is just one of 12 voting members of the FOMC and has no legal authority to exercise control over this body. So why does the media pay so much attention to every word the chair speaks? Does the chair really call the shots at the Fed? If so, why does the chair have so much power? The chair does indeed run the show. He or she is a spokesperson for the Fed and negotiates with Congress and the President of the United States. The chair also exercises control by setting the agenda of the board and FOMC meetings and by influencing the board through the forces of stature and personality. Chairs of the Board of Governors, including Mariner S. Eccles, William McChesney, Martin Jr., Arthur Burns, Paul A. Volcker, Alan Greenspan, Ben Bernanke, and Janet Yellen have typically had strong personalities and have wielded great power. The chair also exercises power by supervising the board's staff of professional economists and advisors. Because the staff gathers information for the board and conducts the analysis the board uses in its decisions, it has some influence over monetary policy. In addition, in the past, several appointments to the board itself have come from within the ranks of its professional staff, making the chair's influence even farther reaching and longer lasting than a 4-year term. The chair's style also matters, as suggested by the Inside the Fed box, styles of Federal Reserve chairs, Bernanke and Yellen versus Greenspan. How independent is the Fed? When we look in the next 3 chapters at how the Federal Reserve conducts monetary policy, we will want to know why the Fed decides to take certain policy actions but not others. To understand its actions, we must understand the incentives that motivate the Fed's behavior. How free is the Fed from presidential and congressional pressures? Do economic, bureaucratic, or political considerations guide it? Is the Fed truly independent of outside pressures? Stanley Fischer, who was a professor at MIT and then the vice chair of the Federal Reserve, has defined 2 different types of independence of central banks. Instrument independence, the ability of the central bank to set monetary policy instruments, and goal independence, the ability of the central bank to set goals of the monetary policy. The Federal Reserve has both types of independence and is remarkably free of the political pressures that influence other government agencies. Not only are the members of the Board of Governors appointed for a 14-year term, and so cannot be ousted from office, but also the term is technically not renewable, eliminating some of the incentive for the governors to curry favor with the president and Congress. Probably even more important to its freedom from the whims of Congress is the Fed's independent and substantial source of revenue from its holdings of securities and, to a lesser extent, from its loans to banks. In 2016, for example, the Fed had net earnings after expenses of $93 billion. Not a bad living if you can find it. Because it returns the bulk of these earnings to the Treasury, it does not get rich from its activities. But this income gives the Fed an important advantage over other government agencies. It is not subject to the appropriations process and is usually controlled by Congress. Indeed, the General Accounting Office, the auditing agency of the federal government, cannot audit the monetary policy or foreign exchange market functions of the Federal Reserve. Because the power to control the purse strings is usually synonymous with the power of overall control, this feature of the Federal Reserve System contributes to its independence more than any other factor. Yet the Federal Reserve is still subject to the influence of Congress because the legislation that structures it is written by Congress and is subject to change at any time. When legislators are upset with the Fed's conduct of monetary policy, they frequently threaten to weaken its independence. A recent example was a bill sponsored by Representative Ron Paul in 2009. The bill advocated subjecting the Fed's monetary policy actions to audits by the General Accounting Office, GAO. Threats like this are a powerful club to wield, and they certainly have some effect in keeping the Fed from straying too far from congressional wishes. Congress has also passed legislation to make the Federal Reserve more accountable for its actions. Under the Humphrey-Hawkins Act of 1978 and later legislation, the Federal Reserve is required to issue a monetary policy report to the Congress semi-annually, with accompanying testimony by the chair of the Board of Governors to explain how the conduct of monetary policy is consistent with the objectives outlined by the Federal Reserve Act. The President can also influence the Federal Reserve. Because congressional legislation can affect the Fed directly or affect its ability to conduct monetary policy, the President can be a powerful ally through his influence on Congress. Second, although ostensibly a president might be able to appoint only one or two members to the Board of Governors during each presidential term, in actual practice, the president appoints members far more often. The reason is that most governors do not serve out a full 14-year term. Governor salaries are substantially below the salaries they could earn in the private sector or even at universities, thus providing an incentive for them to return to academia or to take private sector jobs before their term expires. In addition, the president is able to appoint a new chair of the Board of Governors every 4 years. And a chair who is not reappointed is expected to resign from the board so that a new member can be appointed. The power enjoyed by the president through his appointments to the Board of Governors is limited, however. Because the term of the chair is not necessarily concurrent with that of the president, a president may have to deal with the chair of the Board of Governors who was appointed by a previous administration. Alan Greenspan, for example, was appointed chair in 1987 by President Ronald Reagan and was reappointed to another term by a Republican President, George H.W. Bush, in 1992. When Bill Clinton, a Democrat, became president in 1993, Greenspan had several years left to his term. Clinton was put under tremendous pressure to reappoint Greenspan when his term expired and did so in 1996 and again in 2000, even though Greenspan is a Republican. George W. Bush, a Republican, then reappointed Greenspan in 2004, while Barack Obama, a Democrat, reappointed Ben Bernanke, a Republican, in 2010. You can see that the Federal Reserve has extraordinary independence for a government agency. Nonetheless, the Fed is not free from political pressures. Indeed, to understand the Fed's behavior, we must recognize that the public support for the actions of the Federal Reserve plays a very important role in its decisions. Should the Fed be independent? As we have seen, the Federal Reserve is probably the most independent government agency in the United States. Central banks in most other countries are similarly independent. Every few years, the question arises in Congress whether the independence given the Fed should be curtailed. Politicians who strongly oppose a specific Fed policy often want to bring the Fed under their supervision in order to impose a policy more to their liking. Should the Fed be independent, or would we be better off with a central bank under the control of the President or Congress? The case for independence. The strongest argument for an independent central bank rests on the view that subjecting it to more political pressures would impart an inflationary bias to monetary policy. In the view of many observers, politicians in a democratic society are short-sighted because they are driven by the need to win their next election. With this as their primary goal, they are unlikely to focus on long-run objectives such as promoting a stable price level. Instead, they will seek short-run solutions to problems such as high unemployment and high interest rates, even if the short-run solutions have undesirable long-run consequences. For example, we saw in Chapter 5 that high money growth can lead initially to a drop in interest rates, but might cause an increase later as inflation heats up. Would a Federal Reserve under the control of Congress or the President be more likely to pursue a policy of excessive money growth when interest rates are high? Even though such a policy would eventually lead to inflation and even higher interest rates in the future? The advocates of an independent Federal Reserve say yes. They believe that a politically insulated Fed is more likely to be concerned with long-run objectives and thus more likely to defend a sound dollar and stable price level. A variation on the preceding argument is that the political process in America could lead to a political business cycle in which, just before an election, expansionary policies are pursued to lower unemployment and interest rates. After the election, the bad effects of these policies, high inflation and higher interest rates, come home to roost, requiring contractionary policies that politicians hope the public will forget before the next election. There is some evidence that such a political business cycle exists in the United States, and a Federal Reserve under the control of Congress or the President might make that cycle even more pronounced. Putting the Fed under the control of the Treasury and thus making it more subject to influence by the President is also considered dangerous because the Fed can be used to facilitate Treasury financing of large budget deficits by its purchases of Treasury bonds. Treasury pressure on the Fed to help out might lead to more inflation in the economy. An independent Fed is better able to resist this pressure from the Treasury. Another argument for central bank independence is that the control of monetary policy is too important to be left to politicians, a group that has repeatedly demonstrated a lack of expertise at making hard decisions on issues of great economic importance, such as reducing the budget deficit or reforming the banking system. This argument can also be stated in terms of the principal agent problem discussed in chapters 8, 10, and 12. Both the Federal Reserve and politicians are agents of the public, the principals, and both politicians and the Fed have incentives to act in their own interests rather than in the interest of the public. The argument supporting Federal Reserve independence is that the principal agent problem is worse for politicians than for the Fed because politicians have fewer incentives to act in the public interest. Indeed, some politicians prefer an independent Fed because it can be used as a public whipping boy to take some of the heat off their backs. It is possible that a politician who in private opposes an inflationary monetary policy will be forced to support such a policy in public for fear of not being reelected. An independent Fed can pursue policies that are politically unpopular, yet ultimately in the public interest. The case against independence. Proponents of a Fed under the control of the President or Congress argue that it is undemocratic to have monetary policy, which affects almost everyone in the economy, controlled by an elite group responsible to no one. The current lack of accountability of the Federal Reserve has serious consequences. If the Fed performs badly, no provisions are in place for replacing members, as there is with politicians. True, the Fed needs to pursue long-run objectives, but elected officials of Congress vote on long-running issues, also foreign policy, for example. If we push the argument further that policy is always performed better by elite groups like the Fed, we end up with such a conclusion as the Joint Chiefs of Staffs should determine the military budget, or the IRS should set tax policies with no oversight by the President of Congress or Congress. Would you advocate this degree of independence for the Joint Chiefs or the IRS? The public holds the President and Congress responsible for the economic well-being of the country, yet it lacks control over the government agency that may well be the most important factor in determining the health of the economy. In addition, to achieve a cohesive program that will promote economic stability, monetary policy must be coordinated with fiscal policy, the management of government spending, and taxation. Only by placing monetary policy under the control of the politicians who also control fiscal policy can these two policies be prevented from working at cross purposes. Another argument against the Federal Reserve independence is that historically an independent Fed has not always used its freedom successfully. The Fed failed miserably in its stated role as lender of last resort during the Great Depression, and its independence certainly didn't prevent it from pursuing an overly expansionary monetary policy in the 1960s and 1970s that contributed to rapid inflation in this period. Our earlier discussion also suggests that the Federal Reserve is not immune from political pressures. Its independence may encourage it to pursue a course of narrow self-interest rather than actions that are in the public interest. No consensus has been reached on whether the central bank independence is a good thing, although public support for independence of the central bank seems to have been growing in both the United States and abroad. As you might expect, people who like the Fed's policies are more likely to support its independence, whereas those who dislike its policies advocate for a less independent Fed. Central bank independence and macroeconomic performance throughout the world. We have seen that advocates of an independent central bank believe that macroeconomic performance will be improved by making the central bank more independent. Empirical evidence seems to support this conjecture. When central banks are ranked from least independent to most independent, inflation performance is found to be the best for countries with the most independent for central banks. Although more independent central banks appear to lead to a lower inflation rate, it is not achieved at the expense of poorer real economic performance. Countries with independent central banks are no more likely to have high unemployment or greater output fluctuations than countries with less independent central banks. Explaining central bank behavior. The view of government bureaucratic behavior is that bureaucracies serve the public interest. This is called public interest view. Yet some economists have developed a theory of bureaucratic behavior that emphasizes over other factors that influence the operation of bureaucracies. The theory of bureaucratic behavior suggests that the objective of a bureaucracy is to maximize its own welfare, just as a consumer's behavior is motivated by the desire to maximize personal welfare and a firm's behavior is motivated by the desire to maximize profits. The welfare of a bureaucracy is related to its power and prestige. Thus, this theory suggests that an important factor affecting a central bank's behavior is its wish to increase its power and prestige. What predictions stem from this particular view of a central bank, such as the Fed? One is that the Federal Reserve will fight vigorously to preserve its autonomy. A prediction verified time and time again as the Fed has continually counterattacked congressional attempts to control its budget. In fact, it's extraordinary how effectively the Fed has been able to mobilize a lobby of bankers and business people to preserve its independence when threatened. Another prediction is that the Federal Reserve will try to avoid conflict with powerful groups that might threaten to curtail its power and reduce its autonomy. Under this scenario, the Fed's behavior may take several forms. The Fed may be slow to increase interest rates and thus smooth out their fluctuations because it wishes to avoid a conflict with the President and the Congress over its increases in interest rates. The desire to avoid conflict with Congress and the President may also explain why, in the past, the Fed has not embraced transparency. The Fed's desire to hold as much power as possible also explains why it vigorously pursued a campaign to gain control over more banks. The campaign culminated in legislation that expanded jurisdiction of the Fed's reserve requirements to all banks, not just the member of commercial banks, by 1987. The theory of bureaucratic behavior seems applicable to the Federal Reserve's actions, but we must recognize that this view of the Fed as being solely concerned with its own self-interest is too extreme. Maximizing one's own welfare does not rule out altruism. You might give generously to a charity because it makes you feel good about yourself, but in the process, you are helping a worthy cause. The Fed is surely concerned with conducting monetary policy that is in the public interest. However, much uncertainty and disagreement often exists over what that monetary policy should be. When it is unclear what policy will best serve the public interest, other motives may influence the Fed's behavior. In these situations, the theory of bureaucratic behavior can be a useful guide in predicting the motivation behind the actions of the Fed and other central banks. Structure and independence of the European Central Bank. Until recently, the Federal Reserve had no rivals in terms of its importance in the central banking world. However, this situation changed in January 1999 with the full operational startup of the European Central Bank, ECB, and European System of Central Banks, ESCB, which now conduct monetary policy for countries that are members of the European Monetary Union. These countries, taken together, have a population that exceeds that of the United States and a GDP comparable to that of the United States. The Maastricht Treaty, which established the ECB and the ESCB, patterned these situations after the Federal Reserve in that the central bank of each member country, referred to as national central banks or NCBs, has a role similar to that of the Federal Reserve banks. The European Central Bank, which is housed in Frankfurt, Germany, has an executive board that is similar in structure to the Board of Governors of the Federal Reserve. It is made up of the President, the Vice President, and 4 other members, who are appointed to 8-year non-renewable terms. The Governing Council, which comprises the Executive Board and the Presidents of the National Central Banks, is similar to the FOMC and makes the decisions on monetary policy. While presidents of the National Central Banks are appointed by their country's governments, the members of the Executive Board are appointed by a committee consisting of the heads of state for all of the countries that are part of the European Monetary Union. Differences between the European system of central banks and the Federal Reserve System. In the popular press, the European system of central banks is usually referred to as the European Central Bank, ECB, even though it would be more accurate to refer to it as the Euro system, just as it would be more accurate to refer to the Fed as the Federal Reserve System. Although the structure of the Euro system is similar to that of the Federal Reserve System, some important differences distinguish the two. First, the budgets of the Federal Reserve System banks are controlled by the Board of Governors, whereas the national central banks control their own budgets and the budgets of the ECB in Frankfurt. The ECB in the Euro system therefore has less power than does the Board of Governors in the Federal Reserve System. Second, the monetary operations of the Euro system are conducted by the national central banks in each country. So monetary operations are not centralized as they are in the Federal Reserve System. Governing Council. Just as there is a focus on meetings in the FOMC in the United States, there is a similar focus in Europe on meetings of Governing Council, which gathers monthly at the ECB in Frankfurt to make decisions on monetary policy. Currently, 18 countries are members of the European Monetary Union, and the heads of the 18 national central banks share 15 votes on the Governing Council. Each of the 6 executive board members has 1 vote. In contrast to FOMC meetings, which are unattended by staff from both the Board of Governors and the individual Federal Reserve banks, only the 24 members of the Governing Council attend its meetings, with no staff present. The Governing Council has decided that although its members have the legal right to vote, no formal vote will actually be taken. Instead, the Council operates by consensus. One reason the Governing Council has decided not to take votes is because worries that casting of individual votes may lead the heads of national central banks to support a monetary policy that would be appropriate for their individual countries, but not necessarily for the countries of the European Monetary Union as a whole. This problem is less severe for the Federal Reserve System, or for the Federal Reserve. Although the Federal Reserve Bank presidents do live in different regions of the country, all have the same nationality and are more likely to take a national view in monetary policy decisions rather than a regional view. Just as the Federal Reserve releases the FOMC's decision on the setting of the policy interest rate, the federal funds rate, immediately after the meeting is over, the ECB does the same after the conclusion of the monthly Governing Council meeting by announcing the target for a similar short-term interest rate for interbank loans. In addition, immediately after every monetary policy meeting of the Governing Council, the President and Vice President of the ECB hold a press conference in which they take questions from the news media. A similar press conference is held by the Federal Reserve Chair, but it is less frequent, held only 4 times a year. The large number of members in the Governing Council presents a particular dilemma. The current size of the Governing Council, 24 members, is substantially larger than that of the FOMC, 12 voting members. Many commentators have wondered whether the Governing Council is already too unwieldy, a situation that will get considerably worse as more countries join the European Monetary Union. To deal with this potential problem, the Governing Council decided on a complex system of rotation, somewhat like that of the FOMC, which national central banks from larger countries will vote more often than national central banks from smaller countries. How independent is the ECB? Although the Federal Reserve is a highly independent central bank, the Maastricht Treaty, which established the Euro system, has made the latter the most independent central bank in the world. Like the Board of Governors, the members of the Executive Board have long terms, 8 years, while the heads of national central banks are required to serve for at least 5 years. Like the Fed, the Euro system determines its own budget, and the governments of the member countries are not allowed to issue instructions to the ECB. These elements of the Maastricht Treaty make the ECB highly independent. The Maastricht Treaty specifies that the overriding long-term goal of the ECB is price stability, which means that the goal of the Euro system is more clearly specified than it is for the Federal Reserve System. However, the Maastricht Treaty did not specify exactly what price stability means. The Euro system has defined the quantitative goal of monetary policy to be an inflation rate slightly less than 2%. So from this perspective, the ECB is slightly less goal independent than the Fed. The Euro system is, however, much more goal independent than the Federal Reserve System in one way. The Euro system's charter cannot be changed by legislation. It can be changed only by revision of the Maastricht Treaty, a difficult process because all signatories to the treaty must agree to accept any proposed change. Structure and independence of other foreign central banks. Here we examine the structure and degree of independence of 3 other important foreign central banks: Bank of Canada, Bank of England, and the Bank of Japan. Bank of Canada. Canada was late in establishing a central bank. The Bank of Canada was founded in 1934. Its directors are appointed by the government to 3-year terms, and they appoint the governor who serves a 7-year term. A governing council consisting of the 4 deputy governors and the governor is the policy-making body comparable to the FOMC that makes decisions about monetary policy. The Bank Act was amended in 1967 to give the ultimate responsibility for monetary policy to the government. So on paper, the Bank of Canada is not as an instrument independent as the Federal Reserve. In practice, however, the Bank of Canada does essentially control monetary policy. In the event of a disagreement between the bank and the government, the Minister of Finance can issue a directive that the bank must follow. However, because the directive must be in writing and must be specific and applicable for a specific period, it would be subject to intense public scrutiny. As a result, it is unlikely that such a directive would be issued, and none has been to date. The goal for monetary policy, a target for inflation, is set jointly by the Bank of Canada and the government. So the Bank of Canada has less goal independence than the Fed. Bank of England. Founded in 1694, the Bank of England is the second oldest central bank. The Riksbank of Sweden is the oldest. The Bank Act of 1946 gave the government statutory authority over the Bank of England. The court, equivalent to a board of directors of the Bank of England, is made up of the government and two deputy governors, who are appointed for 5-year terms, and 16 non-executive directors who are appointed for 3-year terms. Until 1997, the Bank of England was the least independent of the central banks. Examined in this chapter because the decision to raise or lower interest rates resided not within the Bank of England, but with the Chancellor of the Exchequer, the equivalent of the U.S. Secretary of the Treasury. All of this changed when a new Labor government came to power in May of 1997, and the Chancellor of the Exchequer, Gordon Brown, made a surprise announcement that the Bank of England would henceforth have the power to set interest rates. However, the bank was not guaranteed total instrument independence. The government can overrule the bank and set rates in extreme economic circumstances for a limited period. Nonetheless, as in Canada, overruling the bank is likely to be a rare occurrence because doing so would be highly public and is meant to occur only in highly unusual circumstances for a limited time. Because the United Kingdom is not a member of the European Monetary Union, the Bank of England makes its monetary policy decisions independently from the European Central Bank. The power to set interest rates resides with the Monetary Policy Committee made up of the governor, two deputy governors, two members, normally central bank officials appointed by the governor after consultation with the Chancellor, plus 4 outside economic experts appointed by the Chancellor. Surprisingly, 2 of the 4 outside experts initially appointed to this committee were not British citizens. One was Dutch and the other American. And some later appointments have also not been British citizens, including the current governor, Mark Carney, who is Canadian. The inflation target for the Bank of England is set by the Chancellor of the Exchequer. So the Bank of England is also less goal independent than the Fed. The Bank of Japan. The Bank of Japan, Nippon Ginko, was founded in 1882 during the Meiji Restoration. Monetary policy is determined by the bank's policy board, which is composed of the governor, 2 vice governors, and 6 outside members appointed by the cabinet and approved by the parliament, all of whom serve for 5-year terms. Until recently, the Bank of Japan was not formally independent of the government, with the ultimate power residing with the Ministry of Finance. However, the Bank of Japan law, which took effect in April 1998 and was the first major change in the relative power of the Bank of Japan in 55 years, changed the situation. In addition to stipulating that the objective monetary policy is to attain price stability, the law granted greater instrument and goal independence to the Bank of Japan. Before this, the government had 2 voting members on the policy board, one from the Ministry of Finance and the other from the Economic Planning Agency. Now the government may send 2 representatives from these agencies to board meetings but they no longer have voting rights, although they are allowed to request delays in monetary policy decisions. In addition, the Ministry of Finance lost its authority to oversee many operations of the Bank of Japan, particularly the right to dismiss senior officials. However, the Ministry of Finance continues to have control over the part of the bank's budget that is unrelated to monetary policy. The recent episode in which Japan's new Abe government put pressure on the Bank of Japan to adopt a 2% inflation target against the wishes of the bank's current governor, who then resigned, suggests the Bank of Japan's independence is limited. The trend toward greater independence. As our survey of the structure and independence of the major central banks indicates, in recent years we have been seeing a remarkable trend toward increasing independence of central banks. It used to be that the Federal Reserve was substantially more independent than almost all other central banks, with the exception of those in Germany and Switzerland. Now, the newly established European Central Bank is far more independent than the Fed, and greater independence has been granted to central banks like the Bank of England and the Bank of Japan, putting them more on a par with the Fed, as well as central banks in such diverse countries as New Zealand, Sweden, and the Euro nations. Both theory and experience suggest that more independent central banks produce better monetary policy, thus providing an impetus for this trend.